Let's keep this short, sweet and simple. We'll discuss in today's video what a stock split is, why stock splits happen and what trends happen during and after a stock split. If you are unsure or don't know much about the stock market, make sure you check out our beginner's guide to the stock market popping up on the screen now. You found yourself at the Money Playbook, where we aim to teach you the world of money and finance. So make sure you're subscribed and you obliterate that like button. So at the making of this video, the big boys, Apple and Tesla, are going through what is called a stock split. So a stock split occurs when companies decide to split their stocks. This means that, let's say a company announces a 3-to-1 stock split. That means that every share of their company turns into 3. So let's say that their shares cost $300 each. After a stock split, that means they will become $100 each. So for an existing shareholder, this is no reason to panic. It just means that the share price is going down from 300 to 100, but instead of you having one share worth 300, you will have 3 shares worth $100. Still worth 300 at the end of the day. So this meaning that a stock split doesn't really have an impact on the price per share. So that leads perfectly into the next part of the video, which is, why would a company bother to split their stocks? Well, the answer to that question is basically to make a stock more affordable for you and me. By splitting the stock, it decreases the price per share. Hence, the smaller investors are given the ability to invest in that company. To relate this to the real world, as I said, Tesla are going through what is known as a 5-to-1 stock split. So their current price is sitting at around $2,200 a share, which is, it's a lot per share. Just to think, as an investor, would you want to actually fork over $2,200 for one share in Tesla? But now, after their 5-to-1 stock split happens, their price will be around $400 to $500 a share. Does it appeal more to you now to buy one share at $400, or would you rather pay $2,200 for one share? Exactly. And that right there is essentially why a company will undergo a stock split. Then the trend that occurs after a company goes through a stock split can further entice companies to split their stocks. So suddenly, if that stock becomes more affordable to small investors, and if all the small investors start to invest, you betcha, the stock price will increase. Many investors may see a stock split as a sign of a company growing and just jump on the trend or the bandwagon. I mean, Apple and Tesla are perfect examples of this. Everyone knows what these companies are, and if their price share decreased to an affordable price, I mean, who wouldn't like to say that they own Tesla in their portfolios, or at least a tiny fraction of Tesla? And just as easily as a stock can be split, the reverse can be done. To go further, let's just say a company has a share worth 50 cents, and they undergo what is called a reverse stock split at a 1 to 10. This means that their new share price is $5. And for the investor, for every 5 shares they once owned, they now own 1. Companies can choose to undergo a reverse stock split if their stock price starts to get ridiculously low, or if they just want to look, so to speak, better in the market. As in, would you rather buy a company that has a share price of 50 cents or $5? $5 just has more of that big boy feel, if you get what I mean. And with that, we finish the video here. Let me know if you've learned anything from today's video in the comments. But remember guys, if you want to learn more about the financial freedom, increase your financial literacy, or help to understand the world of money, make sure you're subscribed to the Money Playbook and you smash that like button. Thanks guys.